Welcome to the Whole Enchilada, a community of high achievers that fight the status quo, rebel against mediocrity, and make life happen. Let's go.
Now we're going to shift our conversation more into specific investment vehicles and how we're thinking about approaching those in our own portfolio mix in our investing moving forward. Before we jump into that, and guys, I'm going to have you guys, we don't have to go in order of these vehicles. We can kind of jump into the ones you want to talk about first. But I do feel inclined real quickly to say this to anyone listening to this conversation is, regardless of your understanding of any of these vehicles, if you don't manage your finances in such a way that you have the ability to invest in them, it doesn't matter how well you understand them. So one of the big things that I'd encourage all of us, us three included, is to say if we're going to have a really purposeful impact on our wealth building over the next several years, we need to get really serious to understand what is my economic opportunity from a business standpoint. Like how confident am I in my ability to generate revenue, and how specific and purposeful am I being in managing my budget in a way that I'm living the lifestyle that I want to live with my family now, with enough left over that I'm serving my future self. When I teach wealth building across the country, I tell people every dollar that comes into my world, I feel an obligation to two families with that dollar. The two families I feel an obligation to are my family as it exists today. That dollar coming in has to take care of their needs and wants today. But I also feel an obligation to the second family, which is the future version of my family. And the dollars I make today are going to have an impact on what kind of life my family lives in the future. I can't say that every dollar that comes in now serves my family now, and every dollar I make in the future serves my future family, or there will be no dollars unless I'm actively working for it in the future. And so I think that drives this conversation. Is it starts with learning to manage your current economic situation from, are you getting paid what you're worth and generating the revenue that is the opportunity at your fingertips? It may be an opportunity to increase skill, relationship, something could significantly increase your income opportunity, and then really getting serious about a budget. And most people in our world have never lived on a budget because that wind's been at our back over the last decade. You do those things and all of a sudden you'll have money left over that then you get to go feel really empowered in putting that money to work. Any thoughts on that concept before we start talking specifically around some of these investment vehicles?
Yeah, I've been investing in real estate for about 15 years. Basically started at like 25. There's just a handful of things that like got me to where I'm at, and then my perspective's pretty drastically changing for the next 15 years of my life. But the last 10 is you've got to live below your means, and living below your means in your 20s is way easier than your 40s, right? Living below your means, even your 30s, is easier than your 40s. When you look up and you got 5 kids and house and cars and school and dance and football and all those things, like it's harder to just like eat ramen noodles sometimes, So I just think the earlier you can catch that live below your means, the better it's going to be. But then living below your means isn't just a fictitious thing. It's because you're trying to move money over to your investment world. And one of the commitments that I made was I was going to move that money into my investment wealth building plan, and I wasn't going to touch it for a couple decades. Truly, whether it was in a 401k or not, I was willing to delay the tapping into that. And I think, one of the greatest inventions on the planet has been time value of money. I realized early in my career, I wasn't going to go invent something. I wasn't going to go start a tech company. I had to go do it the most probable way. And the first 3, 5, 10 years, it is so dang boring. Every dollar, every 10, every 100, every $1,000 matters to get that over there, which, the second you start getting momentum in your wealth building journey and you start seeing a positive number on your net worth balance sheet, that starts to create energy for you to then go out and invest. And then it's crazy. Like you just commit to certain habits for 5, 7, 10 years, you blink and that snowball has actually started to play out. And then you can start being, a lot more sophisticated on your investment journey, on that. So, and I'll get into real estate and some of the future, products or vehicles in a sec, but go ahead, Shoney.
I love that perspective of just like thinking not only about your family's situation today, but also 10, 15, 20 years in the future. Because, money can simply be a vehicle to providing a life by design. And if we use it to our advantage now, we can have our money work for us rather than just investing our time, right? And too often people get stuck on that hamster wheel where they're always trading their time for money. And the problem with that is that that is a marathon that can be very tiring, right? And so the way out of that is really making sure that we have an investment strategy. And I think ultimately everybody has to pay a price. We either have to pay the price of discipline now, so making sure that we have a budget, that we have a spending plan, that we have a strategy to start getting assets, even starting out small, right, and working our way up, or we have to pay the price of regret later. So you pay the price now or you pay the price later, but when you pay it later, you have to pay it with tax. That's the problem. And so that means through lifestyle, people do not live the lifestyle that they want simply because they didn't make the disciplined decisions earlier on. And so that's the probably the biggest encouragement. And one of the gifts, that I've been given is just understanding how important it is to make sure that we have a budget. We have something that we're focused on saving as much as we can towards our investment world, so that we can really get out of that rat race.
Love it. All right, guys, this is why I wanted this group together. I just admire the way you guys think about money, and I love that we all have this long runway ahead of us still, even though we've had an immense amount of success for our ages to our point. We've got this long runway ahead of us. I really have appreciated your guys' perspective and thought that you've brought to the table. Okay, so let's jump into some of these investment vehicles. Where do you guys want to start?
Let me just even back up because, I know we've all been real estate people, which I think we've all done a lot of different things over the last 5, 10, 15 years. But for me, I'm like 99% in real estate assets, businesses attached to real estate, which, if I look back, I think it was a very smart decision because of a couple things. Like number one is the leverage component of real estate is awesome. You put a 5, 10, 20% down payment on an asset that the entire asset is going up in value. You put a 20% down payment that the property goes up 5%, instantaneously you're at a 25% return of your money before cash flow, debt reduction, tax benefits, or whatever. And there's typically a cash flow strategy or a net worth strategy. I'm going to try to go wider and own a bunch of real estate with minimum down payments on stuff that still break even on cash flow, which doesn't do a lot for you as passive income or unearned income, but it does a lot for you on just your overall net worth growing because of the appreciation and the cool factor of a 30-year fixed rate mortgage, especially if you got them under the low rates. The challenge for me is because I went wide, I was banking on my youth and my ability to just go earn other income to pay for my life or my kids or my family or whatever. Now I'm kind of in a point looking at, what Shoney just said. I want to maybe start living off some of that passive income or start transitioning some of my investments into other product types that have a higher cash flow percentage that might not have as big of a bank on your balance sheet, but have a more passive income thing. So I think, even when I go out and recommend asset classes to people, I think people starting their investment journey in real estate, it's hard to beat that in anything else unless you get really lucky or the perfect timing of something, and part of it too is you just got to get at least some sort of chunk of net worth then to be able to start putting it into some of these assets. And I also caution people of just over diversifying too early, because you own $5,000 of a bunch of these things that added up could have been a down payment on a rental property that could have just sped up that net worth growth. So I think you got to pick something. You got to get started. I believe in the law of sequential mastery. It's just master something and get started and then move to the next one. But for me, on the next decade, Shoney and I have talked a million times about non-correlated asset classes, diversification, the right portfolio percentage mix. I think personally, I'm going to move from 99% real estate over the next 5, 10 years. I'll still be heavily primarily in real estate, but maybe more like 60, 70%. That other 30, 40% for me, I'm going to try to supplement more cash flowing assets. So I really like the lending debt, and there's aggressive versus less aggressive like bonds on the other side. So I want a lending protocol, but I also think, I lose about an hour and a half of my day every day trying to stay in tune with just the crazy innovation and technology and advancement of where we're at civilization right now. Yep. And I think we're going to look back at this time period and think that was an incredible opportunity. So we're talking about advancements in medical, industry. We're talking about advancement of AI, You think about data centers, energy production, all of those. So I think all of those are probably very important to pay attention to. So, Shoney's always peer pressure me into getting into certain cryptos and some AI investments, that if you look on it a day to day, week to week, it's crazy volatile. But I think if you blinked and woke up 5-10 years from now, you're going to think that was a very good decision. So I really like a lot of that. But I also think, a lot of wealthy people's advice is get as close to the asset as possible. So again, there's all sorts of middle people that could get in between you and you owning one Bitcoin. You could also just own one Bitcoin and put it on a flash drive and put it in your safe, and nobody's in between you and that Bitcoin. So I think going down the road of commodities and resources, I think is a tremendous path for me over the next decade of, not only gold and commodities and stuff, but I'm talking about even, you think about where we're headed with energy and water use. A Google search versus a Chat GPT search is like a 10 times more power it consumes going through a Chat GPT search than a Google search. So you think about where that energy is going to come from. You think about the data centers, the warehouses that got to get built from that, the water that's got to be pumping in to cool it. So I think there's a piece of that too that I'm going to jump into. So.
Yeah, I think that's it. You bring up a lot of interesting points there, like particularly when I look at commodities, oil, gold. It's escaping my mind right now, but what's the commodity that needs lithium for batteries and data centers? It is like the old gold rush of 1949. Is some of the people that made the most money were the ones selling the picks and the materials to the people going to actually dig for the gold. So I look at that too. With we just invested in a company that's supplying salt water to oil rigs that they have to have, regardless of whether they hit oil or not. They have to have on site, and they have an exclusive contract for it. So like that, to me, that's like a gold rush tactic of saying, they would make more money knowing if they knew they were going to hit oil, but I can consistently make a great return knowing I'm providing the materials to these companies that are taking on the risk, right? So to your point, Johnny, I think it's important for anyone to say, what is my real goal? Which where you outlined one of your goals right now is to now start generating more passive income that can actually be used other than just increasing your net worth. And what is your risk tolerance around that? Like if there's something you're interested in, like a commodity, it's what is the risk associated with that? Is there a way to capitalize on that return with less risk?
Yeah. Yeah, I think I'm most envious of your Pokemon card collection. I think that's probably gonna be one of your biggest assets in the next 10 years. So.
Yeah, and just if anyone wants to steal it, it's in a safe at Johnny's house. Shoney, any thoughts on that, or what asset vehicle should we talk about first? And I don't think we have to spend a lot of time on each one of them individually. I think we just give some quick thoughts on how you view that asset class, and if it's something you're incorporating into your thought process or world right now. And one of the things we can do, if people are finding some interest in this conversation, I think as us three continue to share ideas back and forth of where we're investing, we can find a way to share some insight with our people of what we're actually executing on. But from a strategy standpoint, maybe we think through some of these from how does it react in an inflationary market, and what's the risk associated with it?
Totally. I think so one thing that Johnny was talking about that I think is important is just that idea of diversification. And I was at an event earlier this year, and there was a wealthy individual who said that wealth is created through concentration, and it's maintained or preserved through diversification. And so this idea, if I look back at kind of my wealth building journey, similar to Johnny, most of my wealth has been created from real estate. I focused on one thing. And so I think it is to some extent very important for people to focus their energy, their attention on studying and really understanding one asset class that they're going to go, and focus on. And it comes from this idea that the reality is, Warren Buffett talks about this, that we shouldn't invest in things that we don't understand, right? Because one of his rules, number one rule, is to not lose money. And he says the number two rule is to never forget rule number one, right? And so in order to do that, we have to successfully make sure that we're studying and understanding the assets that we're investing in. And at this point now, I'm kind of shifting more into that diversification realm where I want to focus on other asset classes that are going to safeguard my portfolio over the next 5 to 10 years. Because here's something we'll also have to be, paying attention to is just trends or shifts in the world that are happening, right? And it comes back, a lot of what Johnny was talking about is making sure that we're owning scarce and desirable assets. Like those are the two ingredients to a successful investment is, do I have something that is scarce and a desirable asset? And that's where we should be focusing. And so a lot of the things that, have kind of been thrown out, obviously real estate, for me, I think, crypto is one of those things that we have to pay attention to. A lot of people have heard of Bitcoin, are familiar with what Bitcoin is, which really is just kind of a store of value. But there's so many other cryptocurrencies out there, alternative cryptos, we should call them, that have actual technology behind them. One that Johnny and I have talked about recently is based AI, which is essentially, for simple terms, let's call it a competitor to ChatGPT, where instead of it being centralized, owned by one company, it's actually a decentralized AI platform. This is going to be, and it also has something that is, encrypting the data that's going in there, whereas it's not the same that ChatGPT has, and that's where you guys may have seen some of the stuff Elon Musk has thrown, some fits around OpenAI and not having protection, the proper protection in place for consumers using those resources. Companies like, hospitals or healthcare sectors, banks, they can't just throw all their data into ChatGPT and hope that it's okay, right? And so that's where competitors like Based AI is a cryptocurrency, but you're able to invest in and be able to benefit from those, new technologies that are emerging. So for me, it's definitely going to be technology is a big one. Real estate is another one. And then infrastructure, right? So we need energy, we need more data, we need all these things to actually be able to evolve with the world and where we're headed. So those are kind of the top 3 plays for me that I'm focused on right now.
If you are enjoying this conversation, please, who do you know that you can share this episode with today that will find value in it and would also like to join us on our journey to become the best version of ourselves? And don't forget, please like and subscribe, because this helps me get in front of more people just like you to continue to grow our network and our Enchilada Nation. Thanks again, and let's get back to the episode. No, I think you guys bring up some really interesting points. I fought cryptocurrency for a while, but I really think that anyone not considering it as a potential is missing something. Not to say that I think you should go all in, because there is some element of uncertainty around it. However, going back to the lessons of history, you look at Germany in the 1920s, when they were printing money so fast to fuel some of their political initiatives, that after they lost the war, they in essence were required to pay people back, but no one would accept the German mark. And the German mark does not exist today. And part of that is because inflation, and they printed money so fast, all of a sudden the value, the world perception of that currency was zero. And ultimately, not to say this is going to happen with the US, but it is a possibility at some point as other world currencies get stronger, that they'll look at the value of the US at virtually nothing. So the way I'm kind of hedging against that is, number one is owning assets like real estate, because down the road in 50 years from now, people are still going to need a place to live, whether they're paying me rent in Bitcoin or another cryptocurrency or yen for that matter. It doesn't matter. They still have to pay for it, and that asset still has a value. And on the other side of that is, to Johnny's point, is if that's my strategy with crypto, I'm 2 steps away from the crypto. I also need to create some element of a strategy where I'm 1 step away with it, which will have the most value. So not to say that it's a big part of my portfolio, but it is a part of my portfolio. You guys hit on the other ones I think are really important that I'm going to ask you a question to go a little bit deeper on this. Is I'm also of the belief system that technology, particularly AI, is going to really revolutionize how the world works. And then also the other sector that is the number 1 sector that is the least impacted by inflation, but it's more money is being spent in healthcare now than ever before with the baby boomers. And so how do we, without me becoming a tech wizard, without me actually learning to write code, without me launching a business and becoming a doctor in the healthcare world, how do we capitalize on those industries without becoming the actual expert or the technician within those industries?
Yeah, I think one of the general recommendations I have is have a longer time horizon that you're committed to holding whatever it is. So like if you don't know anything about AI and you just see little glimpse of it, you know it's something miraculous that is on a great trajectory. Even like natural resources, commodities, like we know they don't just keep growing underneath. Like we're eventually going to have less and less of everything that we're digging out of the ground. Like you think about collectibles, you think about stocks. Like I think whatever it is, that one of the biggest challenges people have is the need to visit their capital, or their obsession with it being in US dollars. So I think part of it is whatever it is, like the longer that you most likely hold it, if you're in the right pathway, the longer you hold it, the more thankful that you're going to be holding that. Every smart old person I've ever met will tell me the same thing. I wish I would have bought more real estate when I was your age. I wish I would have bought more real estate when I was your age, right? Or land or whatever it is. So I think you've got to at least do some sort of education that you're on the right pathway, and then just hold it long term. And it's almost contradictory to the way that society and investing is now, because not only our urgency of buying stuff and keeping up with our neighbors and all that stuff, but the technology advancements that make it instantaneous to make a lot of these investment vehicles liquid. Real estate for me, I can't just boom, snap my fingers and go sell it. Like there is a little bit of a process. Yeah, it could happen in a couple weeks with a cash offer, or even a couple months with a normal mortgage or whatever. But sometimes it being more locked up helps me fight against my own natural man of wanting to access that money to go spend it on a trip or whatever.
Yeah. And I think that if you visit it every month, and I do check in on my investments to make sure they're still tracking, like, are all the ducks in a row as I anticipated, right? Because you want to hedge against it. And I don't want to spend mental energy making the same decision over and over and over again. So I think it is really important. And I think all three of us have created some element of money rules, depending on the asset class we're going into, is if I did the work up front to really understand it to the point that I chose that was the best place for that dollar, is I should have confidence in my decision if I did the work up front. Now, checking in on it and making sure that it wasn't something crazy that happened that would change my trajectory is okay, but I shouldn't have to every month re-go through the mental energy to decide if that's still the spot for that money. Because if I'm giving that mental energy again, what I'm not giving mental energy to is the dollars that are sitting in cash today that need to also be put to work. Yeah. So like for an example, like there's been a couple times in my career where I decided I was going to become the best day trader of all time, that I was going to outbeat the market. But that's not my expertise. Could I have gotten good at it? Probably, but it took me away from the things that were really great active incomes for me. So I had to decide what is my real strategy, which is at the end of every year, I identify 10 ETFs that I'm interested in, that I believe in. I believe the strategy. They fall within the sectors and the industries that I believe are going to have a big impact. And then every month I'm investing in those ETFs without having to rethink through, is this my strategy? It's just a matter of pulling the trigger on them, because I did the work beforehand. Even though, could I make more money potentially if I was individually picking the stocks within the ETF that were outperforming? Yes, but it would steal my time away from other important strategies. So I trust somebody that's managing that ETF to do it because I did the research on the ETF prior, if that makes sense.
Yeah. Crypto's that same way with me. I always tell the story. I don't know, whenever Bitcoin was at $7,000, it was like 7-8 years ago, was the first time I got into Bitcoin. And I have successfully bought and sold Bitcoin over the last 7-8 years to the point I've made $0 of net profit on Bitcoin. Had I actually just put my money in and just held it, it's somewhere in whatever it is, $70,000 now, like just staying in it and just trusting the process of your wealth building journey oftentimes will make you more money than even more information will constantly think it. And even for me, sometimes just having a little bit of money in something makes me learn about that asset class way more than I would had I not put my money in. There's certain things that, like, until I have $100 in it, I just don't pay attention as intently as I would trying to learn about it with $0 in it.
Yeah. I think that's a good point too, Johnny, is that too often, people are, we try to time the market rather than trying to just understand that the real principle is time in the market, right? So we have to just stay in the market over time. And going to Marcus's point is it's really doing our due diligence up front. So having some sound foundational principles that, help us to make that investment decision initially. And then just kind of checks and balances. Is my theory, my thesis from the original investment still true today? And if so, then we just got to let it ride. Whatever volatility comes, volatility is actually why people invest. It's actually a healthy thing. Too often, though, we let our emotions kind of get in the way and say, "Oh no, I need to, pull my money out of this investment." And so ultimately, we just have to say, is the core thesis still the same? And one of my kind of benchmarks is asking myself, well, 5 years from now or 10 years from now, I'm not looking at 6 months. I don't want to look at 8 months, because that's when you're going to see volatility and it could be to the downside, right? But if we say 5 years from now, will we live in a more technology-based world than we are today? 5 years from now, are we going to have more households than we do today? Like, that's that scarce, desirable asset factor where I know over time that's going to be a great investment. So I just need to, set it, forget it, let it ride. And again, I can do checks and balances just to make sure that my thesis is still true, but I don't need to, worry about any kind of volatility in the short term.
Yeah, and I think that plays in alignment with what you said earlier too, Shoney, about this idea of is it scarce and is it desirable? And one of the I read a book recently that caused me to think too. One of the questions I've added to my list of questions I ask before I make an investment is there a way for me to get involved farther upstream? Meaning, like, AI is a perfect example. Like, we're all getting bombarded with ways to invest in AI, but the way majority of us are being sold AI is, what is the actual application of AI in your business today? Buy this app, buy this tool. Where upstream, some tech company is recreating the next evolution of that app, right? And which of the 1,000 apps is going to be the one sold for $1 billion? You don't know. It's a guessing game. But if I get involved upstream with the actual company that's developing the apps, right? So that's one of the questions I'm thinking through. Is like, even with commodities, is okay, here's an investment opportunity. Is there a way to get involved with this farther upstream that is going to be a more closer to the source, but also a more sure bet long term?
Yeah, a great example that I heard the other day is like Boeing, right? Boeing has a wait list of 10 years of planes that have already been ordered, deposit, that they're still building them to get them to the actual airlines. And I know Boeing's going through their little PR issues right now, but Boeing is such a popular company. Everybody knows about Boeing. So like, the market anticipates so many of their moves. So by the time like they actually come out and say something, a lot of the smart investors had already written that up. Where the people, if you go back, because all they're doing is putting all the parts together and making planes, but if you actually go upstream to who is, where they're sourcing the different products from and invested into some of those companies, it was actually a way more likely high return of an investment, for you than if you would have put that same money in Boeing itself. So I think upstream is a great recommendation.
Great example. So I know we're running out of time. Here's what I want to do is we're going to rapid fire some of these vehicles. So ultimately, I'll go down the list. I'll say what the investment vehicle is, and you guys tell me if it is going to be a part of if it currently is a part of your investment strategy, if you're in research phase, or it's something that's not a priority for you. So let's start with commodities. Johnny, commodities.
Yep, but I put a lot in there. I put all natural resources, water, commodities, gold, silver, oil, gas. I put it all in there. I think I'll probably be somewhere around 5% of my portfolio in commodities. Yep.
Okay. Yeah, I'm in agreement. I think that we know that commodities are going to continue to be important. We know they're inflation. They do well in inflationary markets. They continue to go up. And same thing for me is now I'm narrowing that down to how do I identify which commodities to be buying, and is there a way to group them together in a form of an ETF or something like that? Shoney, commodities, part of your portfolio currently, or how are you approaching that?
Yeah, kind of same boat, is looking at what are the commodities that are going to have the most impact, over the next 1 to 5 years. So for me, it's more research phase. Perfect. Awesome. Love to hear, as we all put in research into that, how you guys are approaching that, but I'm in agreement. We should focus on that. Real estate.
For sure. Eventually I want to get to 65% of my portfolio in real estate.
Yep. That's been my big focus right now. It's been about 95%, and I want to get that down to about 55 to 60% of my asset class.
Okay. Awesome. Yeah. I tend to be more in the camp of Johnny, just because it's what I've known and loved. Is I think I'll end up somewhere between 65, 75% of my portfolio in real estate. not only because I believe in an asset, but I love how it interacts with any potential change to future economy. Housing will always be needed no matter what, as long as you're buying the right product. What about a lot of people talk about TIPS or Treasury inflation protected securities when they start talking about inflation. Any thoughts on that?
Yeah, I put that all in my debt lending bubble too. So I want to be somewhere in 5 to 10% in that, which is, a hard money, long-term lending, private lending, treasuries, and then just maybe like a diversity of like bonds, whether it's corporate or municipalities. And one caveat going back on real estate, it's not like I'm just going to unload real estate just to go buy, crypto or whatever. I'm dedicating the next 10 years more of my investment, money into these other categories. I'll still always want to be growing my real estate, but hopefully overall I'm diluting it because I'm being more aggressive on the diversification.
Shoney?
Yeah, this has not been a focus for me up to this point. I'm 32, and so a lot of my asset kind of allocation has been a little bit more on the riskier side, higher return side. And so for me, it's just, I like the returns on crypto, on real estate, and some of these other assets. And so that's where I put a little bit more of my attention for now.
Yeah, I'm in agreement with TIPS. The only reason I threw them on here really is because in an inflationary market, I feel like the financial planners tend to sell this product a lot as a hedge against inflation. I think if you're farther down the road in a retirement standpoint and not focused, you don't want to spend time on trying to outperform the market, it could be a good solution for you. Same thing with bonds. However, where we have this long trajectory in front of us, I feel confident that we can outperform that hedge against inflation of TIPS. And kind of bonds fall into that same category for me. Is if you look at how bonds perform in a high inflationary market, they tend not to perform as well as other asset classes. Any thoughts on bonds before we move to debt?
Same boat for me.
Okay. What about, when I think about debt, I'm saying more like, I know we all do hard money lending, which I think continues to be a great return for me, but I'm also talking about borrowing money, because I think this is where a lot of investors are missing the mark right now. They're like, man, I'm used to borrowing money at 3% or 4%. There's no way I'm going to borrow money at 6.5% or 7%. However, I met with a very successful real estate investor, and he's buying as fast as he possibly can. And his hedge against inflation right now is saying that, hey, one of two things are going to happen. Interest rates will go to 12% someday, and I'll have a bunch of assets at 7%, and rents are going to go through the roof. Or rates will come down, and I'm able to refinance and get them at a lower rate at some point down the future. But that's his big hedge against inflation, is actually taking on more debt. And buying more assets. But I wanted to get your guys' take on that strategy, or any thoughts on debt.
Good.
I personally love debt, good debt, right? And ultimately, it's because it instantly magnifies my money. Meaning if I go, for example, on a mortgage and get a $500,000 loan, well, I only had to bring $85,000 to $100,000 to the table, right? 20%. But I'm able to control an asset that's worth $500,000. And as that grows at, let's say, 4%, right? The average over the last 50 years. Well, I'm getting 4% on the 500,000, not 4% on that 100,000 that I put in the pot. And so ultimately I'm able to exponentially grow that, that capital that I'm putting into this asset. And so for me, debt has been a strong force. And if you listen to, people like Robert Kiyosaki, they talk about how the wealthy people use debt to their advantage to grow their wealth over time.
Yeah, for me, anything that my personal emotion is attached to that is correlating with debt, my personal home, credit card debt, car loans, student loans, second homes, even like if you own your own personal office space that like you want to make it nice for yourself, like anything that my emotions attached to, I run from that debt. And it's a trap. Anything that's like an investment optimizing my dollar and debts associated with that, that's just math. It's a spreadsheet to me. And I love that kind of debt.
Yep. Yeah, this is a money rule I created for myself in my late 20s was I refused to borrow money on non-income producing assets, which is very similar to how I like how you described it now, Johnny. And then I tend to be very conservative in my investing. I still am a big proponent of debt on income producing assets, as long as I feel confident that the revenue generated off of that asset will at least cover the payments. that's where, I've been caught once in my career carrying an asset that I had to come out of pocket every month. And it did not feel good. I was never at risk of losing it or going bankrupt or anything like that, but just I didn't sleep well at night knowing like I'm coming out of pocket every night to carry this asset. So I love debt as long as I feel confident in even in a shifting market, the revenue generated would at least cover the debt payment. Yeah. Foreign investment. One thing all three of us are partners in 3,000 acres in South America. I think that was actually a really great hedge against inflation. Any thoughts on foreign investment you guys want to share before we keep moving?
I'm not specifically going out looking for opportunities, targeting it or whatever. We've got some South America stuff strictly because it kind of fell somewhat in our wheelhouse. It just happened to be out of another country and the opportunity fell in our lap. So I think I'm going to be okay, being ready and prepared if something like that happens. But there's just more risk. And again, anytime you step out of the country, you just realize how awesome America is. And my money's on America still the next 100 years, just, compared to a lot of other countries. But when you have to learn a whole nother set of tax laws, investment laws, government, all that other stuff, it brings more variables in that you have to be cautious about. So.
Agreed. Shoney, any thoughts?
Yeah. I would piggyback on Johnny is I think for the short term, 5 to 10 years, my bet is for sure 100% here locally, even in Utah, but then on the U.S. as a whole. But one of the things on kind of on my due diligence list is to look at emerging economies and countries. If we look at places like India, where they're having a massive boom in productivity compared to the rest of the world. And parts of Africa as well. And so part of that is kind of that's more of a 30-year, 50-year type investment horizon where it's saying we could see significantly higher returns if we do look at some of those emerging areas. And so that's more of on kind of my, 1 to 5 year horizon of doing some research and due diligence, but not immediate investment decisions.
Yeah, I think that's a great point. A lot of these countries are no longer considered third world countries. They're considered emerging countries that are emerging markets. And you look at, we've talked about a couple of times, the U.S. government is targeting a 2 to 3% inflation or growth in a market. Where you look at like at India, I think their government's projecting or working towards like a 5% increase in growth per year. So they're like a little bit more aggressive with their fiscal policy because they have the bandwidth to do it because they're an emerging market. So I do think that's interesting to watch. And there's ways to invest in those markets locally through our stock market, right? Investing in a company that's doing the research instead of going directly to their markets, which brings us to the next one of stock market.
Yeah, I'll probably be, 4 or 5% of my portfolio in there. And I'm lumping in mutual funds, ETFs, specific stocks, even just the big tech stocks, Google and Microsoft and Alphabet and Amazon and, Meta and all those. Their ability to just buy a ton of other companies and stuff just always makes them kind of a blue chip stock. So I'm sure I'll have a little bit of money in there for the next 20 years.
Yep. Shoney?
Yeah. For me, it is more of the mutual funds, the S&P 500. I don't want to be on the side of trying to pick individual stocks, especially if you look at, timing over the last 50 years. If you look at how many companies 50 years ago are still on the S&P 500, right? There's almost 90% of them or 95% that are no longer on the S&P 500. And so I don't, especially with all the AI and technology and shifts that are happening, I think that we're going to see a huge shakeup in the next 10 years on best performing companies, to bet on. And so for me, it's more of those, how can I get a whole basket of the top companies and make sure that I'm diversifying through S&P 500 or mutual funds.
Yep. And then I'm big on dollar cost averaging in that situation. It's like just once you've made the decision on the ETFs, the segments of the market that you're committed to, like part of my month end checklist, it may have been lower one day during the month, but part of my whatever day I'm doing month end is I know exactly how much money I'm committed to the stock market every single month. I pull up the 10 ETFs that I've identified as the ones I'm focused on for the year. I pick the 3 out of the 10 that just happen to be the lowest that day, and that's where my money goes that month. It's that much of a rule for me to follow. If you look historically at the Dow, particularly for a decade after a high inflationary period, it tends to stay pretty flat after a high inflationary period. And that's where I think ETFs and things like that come into play. If you identify the segments you believe in, healthcare, AI, tech, some of the ones we identified today, more than likely those will do well over the next decade, even though there is a likelihood, if we follow the lessons of history, that the stock market in general may stay fairly flat or a low return over the next 10 years. So I do think it merits a little bit of, I do think it should play a part of your portfolio and segment it down to what you believe in. But then once you've made that decision, just execute the dollar cost averaging is kind of my thought process. Any issues with that strategy?
Nope. Love it.
Collectibles.
I'm not an art guy. I don't know. Probably not big on collectibles in general. Maybe my Dallas Cowboys sports signed memorabilia that will be worth a lot of money in the future. So,
yeah, this is something I haven't played a lot in as well. I've got a couple things that I've bought more from an emotional standpoint that I don't even consider. They carry value. They are increasing in value, but it's more of a personal ownership piece than it is an actual investment strategy for me. Shoney, any thoughts on this?
Same thing. I bought some collectibles just for my own personal, appreciation, but nothing that I've looked at as like a true long-term investment.
Cool. And then I put on here other. Is there another investment vehicle that we should be thinking about as we consider our portfolio mix over the next decade, particularly considering a post-inflation spike that we've experienced?
I know we tapped on it a little bit, but I just think that crypto is one of those ones that people should do due diligence on, and understanding that it is extremely volatile. But at the same time, if we look at, since Bitcoin's inception, the annual returns year over year have been, just for the last decade at least. So, it's been over 40%. And so it's like, show me another asset class that's been able to rival that. The only one that I've been able to do that with is real estate. So that's where real estate is always going to be my number one. But right now, number two for me has been crypto, and I'm reallocating to move more towards that 10 or 15% of my net worth to be in crypto. And again, understanding the different technology pieces that are on the blockchain. That's probably the most important part right now, is what are the technologies that are being built on the blockchain that are going to actually have a use case within the world in the next 5 to 10 years. And so that's where there's a lot of cool projects that are being built on the blockchain, where it might be investing in, the next Apple or Google, but it's a technology that's built on the blockchain. So it has kind of a dual use case there. But for me, that's a big focus of mine, at least for the next 12 to 24 months.
Cool. Any last parting words from you guys in our conversation today, or any ahas you took away from our conversation?
No, I think you've got to pay attention. You've got to invest in financial literacy. I think you've got to get in the game and then have some habits that are continuing you in the investment game, and then just, have a long time horizon, stick to it and just have a great life, Awesome.
Love it. Shoney?
Yeah, I think just overall, how do you make this conversation is, for me, it's fun to have these types of conversations, because ultimately what it's all in pursuit of is freedom, right? Which is something that everybody wants. And so for me, it's like, money is good for the good it can do. That's something that Gary Keller often talks about. And ultimately, it's about how can you provide a better standard of living or a better experience for your family, for the people around you, and be able to live life on your own terms. And ultimately, it's going to come through investing, through building assets or buying assets that are going to pay you a dividend or pay you and get cash flow that allows you to live the lifestyle that's important to you. And so I think from a starting perspective, I just think it's so vital to get clear about, well, what is my ultimate goal? What am I trying to accomplish? And how much does that lifestyle cost? For some people, that might be $100,000 a year. For some people, it might be $250,000. So you have to actually find your number, not just subscribe to everybody else's number that you hear, kind of out in the ether or online. It's what is actually the lifestyle that you want to live, and how much is that going to cost? And then you can backtrack the numbers from there and identify what your targets are.
Love it. Yeah, I think that's such an important piece to this puzzle. Well, what I'm going to do as a follow-up to this conversation, I've made a page of notes here from things we've either said or ideas that it sparked for me. As you guys know, I'm very much about following investment rules. That once I write a rule for myself, I love to follow that. I know you guys are the same. I'm actually going to go back and modify some of my rules that I'm going to commit to over the next 5-6 years, And if you guys are okay with it, what I'd love to do is share those rules over with the two of you and have you look at them to see how you feel about them. Just because I love how you guys think. I think we're very much in alignment with our investing strategy. And then if you guys are modifying any of your rules, I would love to hear them back, because I think the power of our conversation and ongoing conversation is just going to maximize our ROI moving forward and just make me smarter. So I'll share that over with you guys. I'd love to hear some feedback back. But thanks again for taking the time. I know how busy you guys are. And then let's start thinking through what topic you guys want to talk about next month. And we'll start putting some research in it so we can come prepared and have another investment conversation.
Cool. Deal. Awesome. All right. Thanks, guys.